Is that the reason that's keeping the FII fraternity away from India? The fact that, A, there are other markets, like a China, for instance, which are doing a lot better and better bottom-up stories, and also the earnings slow down along with valuations?
Yes, I think it's a combination of that. This year in particular, it's more that China, Japan, and South Korea are very exciting. Coming into 2025, the South Korean market was a very poor performer. We had the coup headlines in South Korea. The tech sector had sold off. So the setup coming into this year was perfect for South Korea, and we've benefited from that. Hong Kong, China, there's been some false starts over the past few years, but the DeepSeek moment at the start of the year, that was this year, not that long ago, woke a lot of people up to that. And the continued headlines and the progress of the Chinese tech sector is waking people up to that. And Japanese equities broadly have been cheap for a long time. And now you have the whole semiconductor AI story as well. So it's not that the India story has been derailed. If anything, I've gotten conviction that it's very much intact in my last few trips. But other things are better. Our capital is finite. We can't invest in every market. And coming into this year, other markets looked better. The question on valuations is an interesting one. Our contention has always been that India is pricey, not expensive. So what does that mean? It means if something is expensive, you're not getting something in return. But the multiples here are high because it's the highest growth market in the world. For a quarter century, it's been that way. It's the highest ROE companies in the world, the highest earnings CAGR companies in the world. And in the long term, that should remain intact. So for us, we view a market where the long-term earnings compounding has been at 11, 12% a year. That probably should continue. We're seeing more buybacks in the IT services sector, for example, more focus on dividend yields. So when you start adding that up, you get to a potential 13 to 15% rate of return.
And so much liquidity going into IPOs.
Yes. I saw some more numbers that the next 12 months might be $20 billion plus. So the pace of IPOs continues to be high. The size of the IPOs is getting bigger. It's been the busiest IPO market in the world the last 4 years by volume. That should continue. We get the question often, why is this happening? It's quite clear. There's thousands of companies out there. The markets give you a mechanism for compounding your wealth. When I moved to Asia in 2005, there were less than 10 billionaires in India, at least on paper. Now there are more than 200. And it's not just in Bombay, not just in Delhi, but all over the country. Which leads to other opportunities for investors, but businesses also, wealth management, luxury travel, services, goods, experiences, all that. And that's reflected in our portfolio. 20 years ago, our portfolio was very heavily weighted towards consumer staples, towards private banks, and towards IT services. Those are all underweight for us now because we see other opportunities elsewhere.
So where are those other opportunities when it comes to India? And before that, actually, let me finish what we were talking about. What's that headline number that will make FIIs as a pool come back to India?
It's hard to see. I thought that they would start coming back this year, given the underperformance that we had seen already, starting in September last year. So Q4, so after a blistering run for the equity market, in 6 quarters, the Indian market was up more than 60%. In dollars and in rupees. Q4 was weak. We started off weak in the small and mid-cap space. So I thought by the summer people would start coming back to India, and then the whole AI trade has taken off in the late summer. I don't think there's one number for FIIs. Most FIIs remain underweight India. Some see it as too esoteric. Some see it as too specialty, that you need to be on the ground, you need to have followed it for a long time. I don't buy that. But then also they get spooked by the valuation multiples or the historic volatility of this market. But what you have now is a market where the political leadership has been very stable. Up until this year, the currency has been relatively stable. Steady devaluation, but pretty stable. The highest growth companies in the world. So I think it's very appealing. For us, this is a great setup on a multi-year view. Meanwhile, the domestic bid continues to be strong. And I don't see that slowing down materially from here.
So what are your sector overweights right now when it comes to India? Because you're one of the few FIIs who's continued to remain invested in India.
Yes. And so if you look at our top 10 holdings, it's 10 different sectors. That's not by design. It just happened that way. We're bottom-up investors. So we have hospitals. That's done well for us. We have travel, so OTAs, That's done well for us. We continue like that. Consumer tech platforms. We also have real estate. That this year has been a bit of a laggard, but we're still constructive on that space. We do have some financial exposure, but mostly this year has been more about NBFCs than the private banks for us. That might change. Defense also. Despite the run that the defense companies have had over the last 3 years in particular, we still have a lot of capital in that sector, and that opportunity is going to be around for a long time. So those are the main holdings that we have. And then conversely, on the other side, staples, private banks, or banks in general, and IT services, they are the lowest weighting we've ever had. I don't feel like we need to change that. Nothing we learned yesterday as earnings season kicked off has changed that view. However, what's exciting is you're seeing one large pool of capex being announced, and a direct beneficiary here in India. And investors are waking up to the fact that there are opportunities here for that. Everything is not just in the US, Japan, China, and South Korea. So we'll see if that continues. It should, because there's a lot of infrastructure that needs to be built out here.
You know, I often wonder that when you look at the global trends, and like you also rightly highlighted, it's either tech, AI, or their derivatives.
Right.
Can you make that same parallel or draw out the same parallel when it comes to India? Or do you have to really have that consumer tech angle when you evaluate markets and opportunities in India?
There are many fewer companies here.
Yeah.
So the good thing about India, the amazing thing is how broad and deep the markets are. We now have more than 6,000 listed companies here.
Yeah.
Nearly 2,000 with a market cap over $100 million. Now, there's nothing special about that $100 million, but it's still a big number. That's where the liquidity starts to pick up. And despite that, there's very few direct AI beneficiaries that are listed. The ones that are listed, there's some supercomputing EMS companies that are here. We've seen the rally in data communications today, and in some of the companies like ABB, Siemens, L&T, that are seen to be beneficiaries of AI-related capex. But those are parts of a larger company.
Yeah.
Whereas if you look at auto parts, broad and deep universe, defense, the broadest and deepest universe probably anywhere in the world of defense companies here. Yeah. And pharma, hospitals, diagnostics, we can go on and on, real estate, private banks, public banks, NBFCs. So it's a wonderfully broad and deep market, but for this. And this is why then you see India at all-time wides against emerging markets, against developed markets. But it's not going to last, for the reasons we were talking about earlier, that the long-term story remains intact. This should continue to be a high-growth market. If you look at it, the equity market today, capitalization, let's say rough number is $5 trillion, GDP of $4 trillion. In our careers, if India continues to grow at 6 to 7%, then in 20 years, the market will have doubled twice. So the 4 trillion becomes, let's say, 16. And if you look at the US, it's a bit of an outlier, but a 2 multiple market cap to GDP, or more than that, actually. So if that happens here, then you're looking at a market cap for the equity market of 30 trillion plus from 5 today, just in the next couple of decades. So there's going to be a lot of growth. It may not all be tech, but there's so much else to look at, which is very exciting for us. And there are ways to if you do your homework, if you bet right, you sit tight, you can outperform the market. And that's why I'm here. Otherwise, I'd be sitting somewhere else.
Yeah, in South Korea?
Maybe in South Korea.
Japan.
Japan.
Yeah.
Japan.
Okay.